Hello everyone, I'm Jen Kohls with Richardson Capital Management, and I'm joined with Dan Brown, our Director of Investment Management. We're here to provide the economic and investment update of fourth quarter 2022. Looking back at the past 3 months, we saw stocks and bonds both rallied in October and November due to investors feeling encouraged that Fed speakers were predicting smaller rate hikes in 2023. Then in December, stocks and bonds declined once again. The good news is that both equity and fixed income ended the quarter in the positive. Dan, what other highlights would you like to share from the past quarter?
Sure, Jen. So just going back and looking at the very strong returns that we saw from October and November, we felt that that really strong rally was somewhat unwarranted because we didn't really feel the Fed changed their message that much in October and November to justify the really strong returns. And we saw in December with the Fed meeting, again, they kind of have been saying the same thing all quarter. And then on the inflation front, we see it trending lower, but it's still uncomfortably high.
Speaking of the Fed meeting in December, we saw the Fed downshift the rate hikes to 50 basis points from the previous 4 consecutive hikes of 75 basis points each. Dan, what was the overall message to investors from that meeting?
Yeah, the overall message was fairly negative when we got to the press conference with Fed Chairman Jerome Powell. So I'm just going to share a couple quotes that investors reacted to. One of them was, "We have a long ways to go to get back to price stability." And another one was, "The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done." So it's not hard to see why investors reacted negatively to this, as they were expecting, easier monetary policy back in October, November. So the main message from the Fed here at the December meeting was higher rates for longer into 2023, and also don't expect interest rate cuts in 2023.
We've de-risked portfolios a few times in the second half of 2022. Dan, what key factors are we paying attention to that would make us constructive again?
Sure. So we entered 2023 with the portfolio still de-risked, so basically underweight stocks relative to our long-term historic averages. And the factors that we're paying attention to that would make us more constructive on stocks, one is the fact that we feel valuation multiples, like a price to earnings ratio, is still too high for the inflation environment we're in. So the graph that we're showing basically looks at historical data of valuation ratios in different inflation environments. And current day, the trailing PE ratio is about 19 times, whereas historically in this type of inflationary environment, it's closer to 15 times. So we'll think we'll get the opportunity to buy stocks at a cheaper valuation at some point in the year, but it might take a couple quarters. And then we also feel that the earnings expectations are still too high in an economy that's slowing, inflation is too high, and the geopolitical concerns. But again, we think we'll get the opportunity to buy stocks cheaper at some point during the year.
What's our outlook for the year ahead, Dan, compared to the year we just wrapped up?
No doubt it's going to go down as a historically bad year for the financial markets, as almost all categories of stocks and bonds are going to finish with double-digit negative returns, something that most investors have never seen in their lifetimes. And as we look out to 2023, we still think a number of those issues are going to be with us for a while, namely higher inflation, the Fed fighting inflation through raising interest rates, geopolitical concerns, and valuations that we still think are too high for a slowing economy. We think the second half of the year will potentially be a better opportunity to re-risk the portfolios.
Thank you. And thank you for joining us. If you appreciate and find value in these videos, please click like and share below. We wish everyone a happy, healthy, and prosperous new year.